33-kilometer strip of water controls 20% of the world's oil, and one mistake there can crash the global economy overnight. One narrow passage, millions of barrels, trillions of dollars at risk. This is the most dangerous bottleneck in the global economy. Oil, war risk, and global markets collide in one place, and if it breaks, the world pays the price. Tension in global markets rarely begins with numbers. It begins with geography, with narrow passages, with choke points that look insignificant on a map, yet carry the weight of the world's economy. Welcome to the financial story, where money, power, and history collide, and nothing is ever as simple as it appears. This is the story of the Strait of Hormuz, a stretch of water just 33 kilometers wide at its narrowest point, yet responsible for moving nearly 20% of the world's oil supply. A place where a single disruption can ripple across continents, shake currencies, spike inflation, and force governments into crisis mode. To understand why the Strait of Hormuz matters, you need to understand how modern energy flows. The global economy runs on oil and gas, not as an option, as a foundation. Transportation, manufacturing, agriculture, defense, electricity generation all depend on stable energy supply chains, and a significant portion of that supply originates in the Persian Gulf. Countries like Saudi Arabia, Iran, Iraq, Kuwait, and the United Arab Emirates export massive volumes of crude oil. Much of it must pass through this narrow corridor between Iran and Oman before reaching global markets. On a normal day, between 17 to 20 million barrels of oil pass through the Strait of Hormuz. That is not just a number. It represents factories running, planes flying, trucks moving, and economies expanding. Now imagine that flow slowing down, or worse, stopping. The consequences would not be local, they would be global. The vulnerability of the strait has been known for decades, but it became especially visible during periods of geopolitical tension. In the 1980s, during the Iran-Iraq War, both sides targeted oil tankers in what became known as the Tanker War. Shipping routes became dangerous, insurance costs surged, naval escorts became necessary. Even then, the global economy felt the strain. But the modern world is far more interconnected than it was in the 1980s. Supply chains today operate with precision. Inventories are optimized. Delays are not easily absorbed. A disruption in one region quickly cascades into others. Fast forward to the 21st century. Tensions between the United States and Iran have repeatedly raised concerns about the security of the strait. Sanctions, military posturing, drone incidents, and tanker seizures have all contributed to an atmosphere of uncertainty. Each incident sends a signal to markets, not always panic, but risk. Oil traders react quickly. Prices begin to move not only based on current supply, but on expected disruption. This is critical. Markets price fear before shortages actually occur. Even the threat of closure can push oil prices sharply higher. For example, during periods of heightened tension, oil prices have spiked by 5 to 15% within days, sometimes hours. Not because supply stopped, but because the risk of disruption increased. This is how choke points influence the global economy, through expectations as much as reality. Now consider a more extreme scenario. If the Strait of Hormuz were blocked, even partially, the immediate effect would be a sharp reduction in global oil supply. Estimates suggest that removing even 10 million barrels per day from the market would create a supply shock larger than most historical oil crises. Prices would surge. Some analysts estimate oil could move beyond $150 per barrel, possibly higher depending on the duration of the disruption. Energy importing nations would feel the pressure first. Countries like India, China, Japan, and much of Europe rely heavily on imported oil. Higher prices would increase transportation costs, raise manufacturing expenses, and push inflation upward. Fuel prices at the pump would rise quickly. Airlines would increase ticket costs. Logistics companies would adjust pricing. Food prices would begin to climb as transportation becomes more expensive. Inflation is not isolated, it spreads. Central banks would face immediate pressure. If inflation rises sharply due to energy costs, policymakers must decide whether to raise interest rates to control prices or tolerate higher inflation to protect growth. This is the same dilemma seen during past energy shocks. Raise rates and you risk slowing the economy. Hold rates steady and inflation may spiral. There is no easy path. Financial markets would react next. Equities would likely fall, especially in sectors sensitive to energy costs, such as airlines, transportation, and manufacturing. At the same time, energy companies might see short-term gains due to higher prices. Bond markets would become volatile as investors reassess inflation expectations and central bank responses. Currencies would shift. Oil exporting nations might see their currencies strengthen. Oil importing countries could experience depreciation as trade deficits widen. Capital flows would adjust quickly. Safe haven assets such as gold and U.S. Treasury bonds would attract demand. Investors tend to move toward perceived stability during periods of uncertainty. But here is where the modern system becomes more complex. Global debt levels are significantly higher than in previous decades. When energy prices rise sharply, governments often increase subsidies to protect consumers. This adds pressure to already stretched fiscal budgets. At the same time, higher inflation can force central banks to raise interest rates, increasing borrowing costs for governments, businesses, and households. This creates a feedback loop. Higher energy prices lead to inflation. Inflation leads to higher interest rates. Higher rates increase debt servicing costs. Higher costs reduce spending and investment. Growth slows. In extreme cases, this can trigger recession. The Strait of Hormuz is not just an energy story, it is a financial system story. Because energy sits at the base of economic activity, any disruption moves upward through layers of the economy. Now consider the geopolitical dimension. Iran has repeatedly stated that it has the capability to disrupt shipping in the strait if it faces existential threats. This includes the use of naval mines, fast attack boats, and missile systems positioned along its coastline. The United States and its allies maintain a strong naval presence in the region to ensure freedom of navigation. This includes aircraft carriers, destroyers, and surveillance systems designed to deter and respond to threats. This creates a delicate balance. Deterrence reduces the likelihood of disruption, but tension increases the risk of miscalculation. A single incident, a misinterpreted signal, an unintended escalation could trigger a chain reaction. And in a system as interconnected as today's global economy, reactions are rarely contained. Let's break down the potential global impact in layers. First layer, energy markets. Immediate price spike, supply uncertainty, volatility in oil and gas futures. Second layer, inflation, rising fuel costs, higher transportation expenses, increased cost of goods and services. Third layer, monetary policy, central banks forced to respond, interest rate adjustments, policy uncertainty increases. Fourth layer, financial markets, equity volatility, bond yield fluctuations, currency shifts. Fifth layer, real economy, reduced consumer spending, higher business costs, slower economic growth. This chain can unfold rapidly. But there is also resilience in the system. Strategic petroleum reserves exist in many countries. These reserves can be released to stabilize supply temporarily. Alternative routes, such as pipelines that bypass the strait, can carry limited volumes of oil. For example, Saudi Arabia and the UAE have invested in infrastructure to reduce dependence on the choke point. However, these alternatives cannot fully replace the volume that passes through the strait daily. This means the risk cannot be eliminated, only managed. Over time, repeated tensions in the Strait of Hormuz have pushed countries to rethink energy security. Investments in renewable energy have increased, not only for environmental reasons, but for strategic independence. Electric vehicles, solar power, wind energy, and nuclear expansion all reduce reliance on imported oil. But this transition takes time. As of today, oil remains central to the global economy, which brings us back to the core issue. The Strait of Hormuz represents concentration risk. Too much of the world's energy supply depends on a single, narrow passage, and concentration risk is dangerous. It creates a single point of failure. Financial systems, supply chains, and energy networks all become vulnerable when too much depends on one node. History has shown this repeatedly. From the 1973 oil embargo to the 1979 oil shock, energy disruptions have reshaped economic policy, triggered recessions, and altered geopolitical strategies. The Strait of Hormuz sits at the center of that risk today. It is not always in crisis, but it is always critical. Now consider the long-term implications. If repeated tensions continue, markets will begin to price in a permanent risk premium on oil passing through the region. This means higher baseline energy costs. Higher energy costs translate into higher long-term inflation pressure. Central banks would need to maintain tighter policy conditions. Growth could slow structurally. This is how geography shapes economics over time, not through a single event, but through persistent uncertainty. And uncertainty carries a cost. For businesses, it means higher hedging expenses. For governments, it means strategic spending on defense and energy diversification. For consumers, it means higher prices. For investors, it means volatility. The Strait of Hormuz is a reminder that the global economy is not only driven by innovation, technology, or policy, it is also shaped by physical constraints, narrow waterways, critical infrastructure, geopolitical boundaries. These factors do not change quickly, but when they are tested, the effects are immediate. Before we move forward, if you want to understand how global events shape your money, your investments, and your future, subscribe to The Financial Story. We break down complex systems into clear, powerful insights that help you stay ahead, because the world is changing fast, and understanding it is no longer optional. Now, back to the story. There is one final layer to consider: psychology. Markets are not purely rational. They are driven by perception, fear, expectation, and confidence. If investors believe the Strait of Hormuz is at risk, they will act before any disruption occurs. They will adjust portfolios, shift capital, reduce exposure to risk. This behavior amplifies volatility. In some cases, the fear of disruption can have a greater immediate impact than the disruption itself. This is what makes choke points so powerful. They operate both in physical space and in psychological space. And when both align, when real risk meets perceived risk, the impact multiplies. The Strait of Hormuz is not just a passage for oil, it is a pressure point for the global economy, a place where geopolitics, energy, finance, and psychology intersect. And when that intersection is stressed, the entire system feels it. The lesson is clear. Stability depends on more than policy. It depends on secure supply chains. It depends on diversified energy sources. It depends on credible deterrence. And it depends on managing risk before it becomes crisis. Because once disruption begins, control becomes difficult, and recovery becomes costly. History has shown that the global economy does not break all at once. It fractures at its weakest points. The Strait of Hormuz remains one of those points. Quiet most of the time, critical all of the time. And when tension rises, the world pays attention, because what happens in that narrow stretch of water does not stay there. It moves through markets, through economies, through lives. And in a world built on constant movement, even a brief interruption can change everything. If this gave you a new perspective, stay connected with The Financial Story, because history is not behind us, it is unfolding in real time.